Hi, this is Bitcoin Asset Research with Allard. Today I want to talk about convertible debt issuance, how it relates to corporations acquiring Bitcoin for their balance sheets, and how that drives Bitcoin per share as a key performance indicator, and how that KPI drives share price outperformance over time. So the premise we start with, as always, is that more Bitcoin is good. And if you agree with this, it means that you want things that can passively increase the amount of Bitcoin you hold. So as a company, to service your shareholders who are on this way of thinking, you want to increase BTC per share. So there's two ways a company can increase BTC per share. The first is that they generate net profits from their business operations, and then they buy sats with those profits. The second is to go into capital markets to raise money from investors, and then buy sats with the proceeds from that financing round. Financing means issuing securities. This is generally what it means. You can issue equity, preferred equity, debt, convertible debt, or warrants. Now, convertibles is the topic of this video, but I should note that convertibles and warrants, they're actually both quite special because they are option products at heart, which means the company is actually monetizing the volatility of its equity value. Now, if a company issues equity or debt, it is only monetizing its equity value or its debt value. It's not doing anything else. Equity holders are entitled to all the free cash flows of a business, and debt holders are entitled to the interest and principal repayment. And if the company defaults, then it would just be entitled to all of the company's assets on its balance sheet. But volatility is different. Monetizing volatility means that you're monetizing how much the value of that equity can move due to uncertainty and due to just market forces. So if we think about it in terms of statistics, the first moment of the distribution is the mean. This would be monetizing either the equity value or the debt value. It's simply the expected value, the average expected value across the market of what the return on the equity value would be. The second moment of a probability distribution is called variance. Variance is really how wide a probability distribution is. And the square root of variance is standard deviation. And the financial term of standard deviation is volatility. So you can kind of see how it all ties together. By monetizing volatility, you're really pulling capital, you're pulling money out of the second moment of the probability function. So how is this possible? Well, it's possible because convertibles and warrants, they're inherently options at heart. So options shield the owner of the option contract from one side of some stock's price action. That creates some inherent asymmetry, and we can look at some charts to see that. So here we see the value of a call option with respect to the value of a stock's price. And this really just shows the inherent asymmetry of options. Because if a stock price is extremely high, the call option's value goes extremely high. But if a stock price goes past a certain point, the call option's value is just zero. You don't lose money past that. So now imagine what happens if a stock is extremely volatile. There's a huge chance it could end up way out there with a very high price, and this would push the call option value up. And there's also a huge chance that the stock price could end up very low, and this would make the call option value at zero. But the problem is that because there's this long tail of the distribution where the stock price can end up incredibly high, the more volatile the stock is, the more the value of the option must increase. If there's a larger chance that the stock price ends up way out there, very high, then there's a larger chance that the call option's value will end up very high. So it follows that because of the inherent asymmetry, options gain value when the stock price has volatility. So the more volatile a stock is, the more an option contract could potentially pay out. And so the more the option would be worth. This is why options are deeply linked to volatility. Now, if you like this video so far, I just ask you to like, share it, subscribe, leave a comment or question or suggestion. I really appreciate it. So options are equal to volatility. And so selling options is like selling volatility, and buying options would be like buying volatility. So when a company issues convertible debt, this is actually what happens. It's effectively borrowing money from the investor while giving that same investor a call option on the company's stock, okay? So now the investor gets a call option. So he gets that ability to take advantage of higher volatility. So because the option has value, it reduces the interest rate on the debt. Now, the more volatile the stock is, the more valuable the option is. This is the relationship we just talked about. And the more valuable the option is, the more the option will reduce the interest rate on the debt. Now this is very important. So here's the killer strategy in action. Bitcoin is very volatile. Everyone knows this. As a company, you can borrow money to buy a lot of Bitcoin. Now your company's equity has what is effectively leveraged Bitcoin exposure, right? Because you've borrowed money, you've bought Bitcoin, so now you've leveraged Bitcoin. This magnifies the volatility of your stock because, again, your equity is now leveraged Bitcoin, and Bitcoin is very volatile, so that magnifies the volatility of your stock. That increases the value of your options because, again, higher volatility means higher options prices. So when you issue convertible debt now with these higher option values and a higher volatility, the attached option will be more valuable, so the interest rate on the debt will be lower. Now take the proceeds from this convertible debt raise and use it to buy more Bitcoin. What just happened? You just got even more leverage on that Bitcoin exposure. So now your equity got even more volatile. Now this increases your option values. You can probably see where this is going because now when you issue convertible debt again, that has an even higher option value associated with the debt, which means even lower interest rates. We're assuming everything else is equal, right? And if you repeat this process, you basically get this hyper leveraged Bitcoin exposure and the ability to raise money at extremely low interest rates. The total cost of convertible debt is really just that very low interest rate plus the dilution of equity. So what do we mean by dilution of equity? When that call option on the debt is exercised, the company simply creates new shares and gives these shares to the convertible debt investor. Now this is dilutive because you're introducing more shares to the share count. But you have to remember that even though it is dilutive, if you have done this correctly, you would have been able to increase your Bitcoin per share even though there are more shares. So the logic here is that by using that money to buy Bitcoin, you would have increased the amount of Bitcoin you hold as a company faster than the rate at which the amount of shares have increased. So the net effect of this is that Bitcoin per share is still increasing. From that perspective, the strategy was accretive. The real cherry on top here is that your interest rate would be so low, which makes your interest expenses very small. Here's the huge impact of this. Let's say you make only $80,000 a year, so you can only borrow $1 million, assuming you pay 8% interest rates, right? So the 8% interest rate on $1 million, that's going to be exactly what you make every year. But at 2% interest rates, presumably using convertibles, you can now borrow $4 million. And this makes a very big difference because if you're just buying Bitcoin with what you borrow, that's literally a 4x difference between how much Bitcoin you can buy at once. That's also going to make a difference in terms of how you run the strategy because, again, you want to leverage your equity even more. And MicroStrategy has been running this exact playbook since 2020. Here we see on December 11th, 2020, they raised $650 million at 0.75% interest rate via convertible notes. And fast forward 4 years later, we have a whole list of convertible note maturities. And these are all at extremely low interest rates. And this is very helpful because you can see the difference between convertible note interest rates and just normal debt interest rates, right? This is a huge difference. Here's the most recent convertibles offering where they got $1 billion at 0.625% rates. And the net result of doing this kind of stuff over and over again looks something like this. Here's the top 9 performing stocks in the S&P 500. MicroStrategy is not yet in the S&P 500, so these are just the top 9 stocks. And you can see that MicroStrategy has absolutely crushed the top 9 and has even beaten number 1 in the S&P 500 by a very sizable margin. Now, all of this is, of course, only possible because of MicroStrategy's volatility. Here we have the volatility of the S&P 500, that's the VIX. It's at 20% annualized volatility. Bitcoin's volatility index from Deribit, it's at 58% annualized volatility. And MicroStrategy right here has basically 100% annualized volatility, so basically 5 times higher than the S&P 500 and almost 2 times higher than Bitcoin at times. Like here it's gone up to 150% vol. So question, how do you borrow $1 billion at less than 1% interest rate, like the way MicroStrategy has? Just a reminder, the US government currently borrows at 4% interest rates. I just took a look at the 2-year and the 10-year. They were both hovering around 4%. The answer is you get 100% annualized volatility on your equity, and then you monetize that volatility by doing convertible debt. This is really an advantage that only corporations have. And I think it's very, very important to understand this key point. Only corporations have this advantage. Individual people can obviously borrow money. Like a mortgage, you're borrowing money. You can take out a personal loan or car loan, student loans. You can borrow money, but you can't sell the volatility of your net worth. You can't sell the volatility of your earnings potential. That's just not a thing that can happen. Nation states can print money and they can also borrow money, but they can't sell the volatility of their currency either. Right? And frankly, nation states, they don't want a volatile currency because that would lead to turmoil within the economy. So basically, selling volatility is exclusively a corporation thing. This is exclusively something that you as an investor can only get exposure to if you're buying companies that are doing this strategy. And more companies are catching on to this strategy's spectacular results. Again, we just come back over here, we can see these results are absolutely spectacular. You should expect more companies to start doing something like this. Now, as a Bitcoin-focused investor, that's what you should look for. Look for companies that are doing this intelligently and buy equities for their ability to increase Bitcoin per share. So here's some smart questions to ask in your due diligence process. How low is the interest rate that they can borrow money at? Of course, this is linked to the volatility of the stock, because the more volatile the stock is, the lower the interest rate on the convertible debt issues. How much interest expenses can they cover with their profits? For this, you have to look at their revenues. You have to look at their growth over time and their costs over time. So what are their profits and how much interest can they service? And by extension, depending on how much interest they service, we can back out how much money they can borrow, and then from there, back out how much Bitcoin they can buy. And now we can answer the question, okay, how much Bitcoin can they actually buy? How expensive also is the equity? You don't want to pay too high of a price for something that isn't able to grow Bitcoin per share as fast as you would like. Is this valuation of the equity, is that justified by how fast it can grow Bitcoin per share? How does it compare to the other companies which do this? Most likely, MicroStrategy is going to be the champion here. They've been doing this for a long time. They're doing it really well, and they're getting to this point where they have a lot of scale in how they do it. They have a huge amount of liquidity, so it's going to be hard to compete with MicroStrategy. But I'm sure that as time goes on, you'll probably see some other contenders emerge. So that concludes this video. If you liked it, please like and share, and leave your questions and comments in the comment section below. Thank you so much for watching, and I'll see you in the next video. Bye.